Welcome to Ironton Capital, and today you're going to discover the 4 pillars of diversification that allow us to manage risk on your investment in any set of market conditions. This is really the secret formula to our funds, so grab a pen and paper and you're going to want to write down some of the ideas. If you're missing any of these 4 pillars now, it might be why your investments are not doing as well as they would be if they're managed differently. So how are you doing today? Have you ever wondered what it would be like to wake up in the morning with all the time that you need to do what you want rather than what you need to do because your investments are making returns on autopilot? Would you like me to share how you can get more diversified within your portfolio or your self-directed IRA with less work? You're about to discover how to get off the 1031 exchange treadmill and go from being an active to a passive investor while managing your capital gains exposure. Well, that's what you have been asking us for, and those are the sort of topics that I want to talk to you today about. So I promise that by the end of our time together today, you're going to know everything about this topic so you can work smarter and not harder. Does that sound good? Here's the key problem that we're really trying to solve here. Too many investors are making decisions based on what they hear on CNBC or at the coffee shop. They're not aware of the cycles in real estate investing or the trends across the country, let alone locally. And that's not your fault. After putting in the long hours at their career and your business, very few of the professionals that invest with us have the time to dive deep into the numbers and the trends. So as you listen to me now, know that it's my intention to help you fix that problem, because the more you listen to me, the more you're going to learn and the better decisions you'll be able to make based on hard data and not gossip. Because the fact is that you're here today to learn about how to make that shift in your investing style. You're ready to take action. So what are the 4 pillars of real estate investing? They're simply the 4 key factors that allow us to diversify in any market condition to tightly manage risk so we can make decisions based on hard data and not hot tips or guts and intuition. We all know that knowledge is power, and I want that for you, the power to know when to act. Does that make sense? Excellent, because now is the time to grasp that power. The time is now because the markets are changing, and if you're not ahead of the trends, you'll be left behind. The time is now because investments wait for no one particular investor, and you've also got to manage your risk. And the time is now because, not now, when would you do it? So notice something. I'm going to show you some current case studies and hard data today, and none of that is to be interpreted as a claim of income or anything related to that. So I have to give you a bunch of disclaimers from our attorneys, the most important of which is simply that there's a lot of forward-looking statements in the discussion we're going to have today. So you're going to hear things about our current expectations and words like will, may, should, expect, plan, seek, anticipate. Those are based on our best understanding of the market right now, the best information that we've gotten from the sponsors with whom we work, and other industry experts that we've consulted with. You're going to want to make sure that you consult with your CPA, your financial planner, and your attorney to make sure that the funds that we talk about are an appropriate match for your portfolio, your family's needs, your risk profile. So in short, your results are up to you. I can't predict exactly what's going to happen because how this blends in with your overall portfolio, of course, is unique to your particular situation. So if you haven't been on any of our webinars today, I'll do a mercifully short introduction for you. Oops. So there's 3 of us at Ironton Capital that are on the investment committee. There's myself. My background is I worked in corporate finance for a couple of years, went back to business school. I worked as a strategy consultant for 8 years, and I've been spending the last 2 decades in real estate. So I've been a real estate developer, I've been a landlord, and I've done a lot of high value add projects, mostly with multifamily, somewhat with office, and a little bit with warehouse. I've been able to get over 20% annualized returns over the lifetime of that couple of decades. Vital, who's also on our team, was an investment banker. He also has an MBA, and he owns about 80 rental properties currently, and he manages more than that for his colleagues. He's also got a very strong lifetime return on investment. Brent Geyer rounds us out. He's a CPA. He was at KPMG for a while, and then he worked doing real estate development on a large corporate scale at InterWest and Pulte before he joined us. He's also been a landlord for forever and a day, so we're really excited to have him on our team as well. So the fastest and most predictable path to financial security and growth is through passive investing. So if you could put your investments onto autopilot, then you're well on your way to true financial freedom, particularly if you can do that in a reasonable amount of time. So really, passive equals freedom. Yeah, I believe that's what we all want, the freedom to experience life to the fullest while we're still healthy enough to be able to enjoy it. And ultimately, that's what all of our training is about. Ultimately, that's what this particular class is about. Consider for a moment how good you're going to feel when you can actually stop trading hours for dollars and actually enjoy your time, your travel, hobbies, and philanthropy. So, our ultimate mission today is to help you do just that because knowledge is power, and I'm going to dive in. Would that be all right? Great. There's some challenges that are out there. There's a lot of information out on the internet, and it's hard to sort through it all and to find the lucrative patterns that help you to make great decisions. We all want to add more investments to our portfolios, but there's only so many assets that we can effectively manage. We tend to think that our portfolios have to be much bigger before we can participate in true commercial grade real estate. So you've probably educated yourself as much as you can with the time that you have available with your family and your busy job. And you've probably acquired assets that are eating up more and more of your time to manage, particularly if you're an active landlord. So unless you want another full-time job, or you're just trying to hold out long enough to hit that tipping point where you can retire, it may be getting harder and harder for you to manage all these things. So what would be nice is if you had a simple proven process to be able to manage all of your investments a little bit more effectively. When you leave the heavy lifting to the experts, you're going to immediately notice how much happier you are and how much easier it is to build a legacy. So during our time today, you're going to have the opportunity to see the world of investing through our experience. You're going to see how the system has changed, our whole take on how we went from active to passive investing. And I know that's a journey that many of you are on as well. If that sounds good, let's start getting into it. So we want to ignite a freedom epidemic because when you're free, you are happy, and when one person is happier, that spreads to everybody around them in increasing ripples, and it makes the entire world a slightly better place. And it'll be good for our kids and grandkids too. That's what I want. I assume that's what you want as well. So, what is different about how we do investing? After all, you've done all this work to create the money. You've got a lot of work on your portfolio so far. I have too. What's the difference? So imagine and picture a simple investing system that allows you access to high grade investments passively. A simple proven system that's the backbone of your entire investing process. Imagine continuously that you're feeling the weight lift. You're getting lighter and lighter as you move from active to passive investing. Give yourself the opportunity to relax and leave finding and managing these investments to the experts. Sort of like you do with your mutual funds. You're probably having someone pick the stocks for you. You're probably not doing it yourself. Hopefully you've got a pen and paper handy as we're going to dive right in. I'm going to show you the exact numbers and we're going to go through some case studies. You ready to get started? So let's debunk just a myth or two. Lucrative investments actually are all around us, and yet there's common myths I hear every day. I don't have time to invest. It's too hard to find good deals. Managing a portfolio is like having a second job. I also hear if I can't write $1 million check, I can't get access to the best deals. And if you're not a multimillionaire, it might take years and years to get enough money to get that kind of diversified portfolio. So I want to pull back the curtain and reveal the system that we like to use when we construct a portfolio with case studies that shows you how a smaller individual investor can get the advantages of the bigger investors. And I'll even share some of the results. So let's get into the specifics of all this with you. So I know that you've been doing well in your profession. That's why you've got the excess cash to be able to invest with us. And you've probably had good success with your investing as well. That's probably how you found us. So some of these pillars that we're going to talk about will be concepts that you recognize, but maybe you'll get a little bit of additional information over and above what you already know as a foundation. So you know that what we have here to say is true. You likely have struggled with some of these factors in the past because part of the magic is how they work together. Does that make sense? While investing can be complicated, you'll see that this time it can be simple because you're ready, and this time our system is going to make it easy, and this time you're going to have some help. So here's the 4 pillars in order, and then we'll go into depth into each of them. So we're going to talk about geography. So we want to be in multiple markets with our key investments. Asset class, from residential to apartments to office, industrial, hospitality. We want to be in multiple asset classes. Strategy, we want multiple types of investments that are trending in a way that's advantageous to where the market is today and to where we think the market's be going to next. And then lastly, we want to work with proven sponsors and have a diverse group of sponsors so that we remove other types of systemic risk from our portfolio. So part of the key difference between an amateur and an expert investor comes down to the experience and know-how on how to diversify, how to track the trends, and then translate that into actionable and accountable investment strategy. And of course, we have to update this constantly as the market changes, because that's always an ongoing moving target. Now, I realize you generally can't get a piece of all four without writing $1 million worth of checks, but that's why we created the National Diversified Fund for you to achieve this sort of diversification. A typical diversified fund will have about 100 investors of about 100,000 each, which gives us a $10 million fund, and we'll usually write about 10 checks for 10 different investments of about $1 million each, and that's how we get access to some really fantastic projects. So let me show you just a little bit more about what we mean here. First, I want to start off with geography. So one of the things about geography is we like to focus on states that have tax advantage status and have a friendly business environment with a regulatory environment that's favorable to the investor or the landlord. So for example, many of you are in Colorado, and you probably have witnessed in 2013 there was 8 new pieces of legislation, and in 2024 there were 4 more new laws, all written from the advantage of the tenant against the landlord. So it's much more difficult to be a landlord now than it was even 24 months ago in Colorado. If you have or had all of your portfolio concentrated in Colorado, you suddenly have got a huge amount of exposure to legislative risk that no reasonable person would have ever anticipated, even as recently as 24 months ago. So that's one sort of thing with geography and diversification that we're trying to accomplish. The next thing that we're looking for with geography is we want to diversify primarily into high population growth states and states with a lot of employment growth. So here's a chart from the Census Bureau showing all the counties in America, and you can see the dark green codes the neighborhoods that are growing the fastest, and the dark red codes the neighborhoods that are growing the slowest. So you can see there's population drifting away from California, Illinois, and New York, most particularly, and there's a lot of population going to Texas, South Carolina, Georgia, and Florida. So why that's important is if you're in a state with a large amount of population growth with employment growth to match, there's going to be a lot more demand for apartments and housing, which puts upward pressure on prices. In a state like, let's say, Illinois or California, where you have a declining population, there's no need to build new houses, there's no need for new condos or apartments, and there'll be downward pressure on prices, so it's hard to achieve the appreciation that we'd like to be able to see. Additionally, just by coincidence, perhaps not coincidence, these states, California, Illinois, New York, are relatively business hostile, more difficult to build there, a lot more of a process getting through the approvals to get the permits and zoning to build the project, versus Texas, Florida, South Carolina, very business-friendly states where it's easier to get things done. There's not as much interference and red tape. So would you like to hear one of our favorite sources to validate what we look at for population? We like to look at the U-Haul website. So when we take a look at who's got the most inbound traffic versus outbound traffic for U-Haul, these are the states that float at the top of the list: Texas, Florida, North Carolina, South Carolina. And just not by coincidence, these are on our top 15 list of states that we like to focus on as well. Don't you love just how the data sort of stacks up like that? So let's take a look at Pillar 1 in action. This is our first 4 diversified funds and where those investments went. So you can see that we've got 1 in New York, 1 in Massachusetts, and a couple in California, which are not our favorite states, but they were unusually compelling opportunities. The majority of our projects are in the southeastern states and Texas, and those are for the reasons that we just sort of outlined there. So if you take a look at Fund 1, you can see the diversification that we achieved just from a geography. And we actually go to the trouble to go fly to these locations, visit the sponsor, visit the project, examine the sold comps, examine the rent comps we're currently using to benchmark the value of this investment, just to double check all the assumptions that we've seen. So our investors like Heidi and her husband really like the access that Ironton Capital has given them to a geographically diversified and sector diversified real estate portfolio that's been carefully thought out with established development partners. And you can take advantage of this, of course, as well. The second big element of diversification is going to be on the asset class. So let's just briefly talk about what the commercial asset classes are, just so you've got a little bit of a background on that if you're not familiar. So the first is residential, and that's going to primarily be single family homes and condos, something that many of you as landlords are very familiar with. The second will be multifamily, so this will be larger apartment complexes. We talk about class A, B, and C. So A is the nicest, C is the least nice. Generally, the A properties are also in slightly better locations as well. So one of the nice things and one of the curses of this is that these are usually 1-year leases, so you're constantly turning over your base of tenants. But the nice thing about that is that you can mark to market right away on your lease amounts. So over the last couple of years, we saw that rents in most markets in the U.S. were going up very rapidly. And since the lease renewals generally happen every year, you can take advantage of those rising lease rates almost instantaneously with a multifamily, as opposed to if you're in an industrial where all of your leases are 10 years long. If you find yourself as a landlord in a heavy lease rental rate growth environment, you're still trapped with these old legacy leases at cheap rates until all those years go by, and then it's time for a lease renewal, and then finally you can get caught up. Generally speaking, it works to the landlord's advantage to have slightly shorter lease durations so you can take advantage of inflation and the asking rates for leases. If you're in a rare situation where the lease rates are going down, like that would be for office right now, the long lease duration protects you because you may have signed a 5 or 10-year lease with an office tenant at what was a high rate 3 years ago when the market rates are much higher. Now the effective rates are lower, but that tenant is still going to be paying you that higher rate for quite a while. That doesn't happen nearly as often as the rising lease rate environment. So that's one element about multifamily. Another important thing about multifamily is that the tenants don't ask you for any customization. They just take the apartment as it is. We're going to talk about why that's important with industrial here in just a minute. A final thing about multifamily is that it has the least amount of risk. Over a long time horizon, we see the least volatility with multifamily. It's also the class with the least amount of return. So as you'd expect, you trade a little less volatility, a little less risk for a little less return. We find that to be very appealing. So usually about 2/3 of our portfolio is going to be in multifamily. So looking at office, this is the segment that no one's very happy about right now, and we're not doing a whole lot in office right now either. I do think that we're probably approaching bottom dead center on office in many geographies. I can't prove that. I don't have enough confidence in it yet to act on that. We're going to wait just a little bit longer before we put money into office. Next up, we've got industrial. So industrial tends to be long-term leases. Industrial has very low overhead costs, and it's also a type of investment that doesn't usually require nearly as much work on the part of the landlord. This type of a lease usually is called triple net or NNN, and what that means is that the person who's on the lease is responsible for the maintenance, snow removal, property taxes, utilities, pretty much everything. So the landlord is typically just getting a check in the mail once a month, which is a very, very nice thing. It's very, very simple. The bad news about industrial is that the rate of returns tend to be not all that high. One additional headache that does happen with industrial is that the tenant will often ask the landlord, I'd like for you to customize the space for me. I don't want to spend, $50 per square foot to make these changes. I want you to do it and just increase my amount of rent by some amount to offset. So it does take a little bit more working capital, which can sometimes dilute the returns a bit. Overall, though, we like industrial quite a bit, and we try to get a little bit of industrial into every one of our funds. Retail, as you might expect, is just when you've got a shop that is based in a unit that you've got. We saw over the last decade that Amazon and other online vendors gutted out some elements of retail. For a while, retail was not thought upon as a very favorable asset class to put money into. Most of the business that were going to be adversely impacted by retail have gone through that transformation, and what's remaining for retail are relatively Amazon-resistant products. The classics would be getting your hair cut, dropping off your dry cleaning, getting your nails done, visiting a liquor store, things like that. Things that you can't really put onto Amazon that have got to be done in person. Retail right now is doing extremely well. There's not very much vacancy across the U.S. in general for retail, and the rates are pretty good. We haven't invested a lot in retail, but we do like it, so it's just a matter of time. The next asset class is hospitality. So this is when you've got a hotel. We like hospitality a lot, but we're very specific, just like we are with industrial, about what type of hospitality that we like. The more luxurious end of the market tends to have slightly higher returns, but a lot more volatility through the course of the economic cycle. So when times are lush, you see a lot of conventions, a lot of business travel, really upscale personal travel that will go to luxurious properties, and they'll pay a lot, so the returns can be spectacular. The problem, of course, is that when you have a recession and times are tight or there's great economic uncertainty, all that is elective and a lot of it evaporates relatively quickly. The business or personal travel that does have to occur during a recession, a lot of times those customers will trade down to a lower cost hospitality provider, and that leaves the upscale really with a lot of volatility in their cash flow. So more return, more risk. That's just not a fit for how we like to construct our portfolios. What I really like is extended stay on the economy segment. So there's a couple reasons for this. First of all, economy tends to be always busy. During good times, there's people who want to economize just because they're on a tight budget, so they fill the economy places. And during a downturn, the people who tend to economize just don't travel at all, but you have trade down for the people who would be staying in a more expensive hotel will now stay at an economy hotel just because they've got to make ends meet. So the economy sector tends to have lower returns in composite, but much less volatility over the entire economic cycle. So that's why we like that. It's just a more reliable bet. We like the extended stay segment, which is people who are staying for 7 nights or more, a lot more than the typical hotel, which is transient with 1 to 3 night stays being really typical. The reason for this is that the 7 night plus group represents about 21% of the overall guest nights across America, and yet only about 10% or 11% of the hotels in America are geared to the needs of the long traveler. That being that they've got a refrigerator, a microwave, probably like a small oven and a small kitchen within the unit, that they've got a washer dryer somewhere on site where it's easy to do your laundry, and that they're just geared up for a place where you might just spend a year, or not a year, like a month or so. So the drivers of demand for the 7 night plus stay are generally not very economically sensitive. So they take place no matter where you are in the economic cycle. So I'll give you an example. Last week, there was a hurricane that landed in Louisiana and knocked out a lot of the electrical grid. So this week, I would expect that every electrical lineman within like a 5 or 10 state radius around Louisiana has dispatched all of their spare electrical guys to Louisiana to rebuild the electrical grid because there's so many customers that don't have electricity right now. And all of those guys are going to stay at extended stay economy hotels. That's just where they tend to land. And it doesn't matter if it's a really booming economy or if it's a recession. If the power is out, that electric utility is going to demand a lot of people to come put the grid back together regardless. So that's one really good example about the non-sensitivity of the economic cycle to extended stay and why we really like that a lot. Other examples would be travel nurses that are filling assignments for a hospital that might need to have a few more staff at a peak time. You have people that are moving from one town to another, and they're going to live in the extended stay hotel for a while they get to know the neighborhood and figure out where exactly they want to live. You might have people within the same city that have sold their old house, timing it to roll into a new construction, and then the builder doesn't deliver the home on time, but they've already sold their old house. They need somewhere to stay for 6 weeks while the builder wraps it up. This is where they land at. Just some examples of the types of people who tend to stay in these hotels and why we like it so much. That probably illustrates it enough, and in a couple of our webinars, we talk about that in quite a bit more detail. I love hospitality, particularly that one segment. It's it's a very good bet, and I think it's very broadly overlooked by a lot of people. Land. This is where you're going to buy a piece of raw land get the entitlements or the zoning approval from the local government to build whatever has been indicated to be built there, and then get the utilities installed. So that would be water, sewer, gas, electric, and probably your internet hard services, and then putting in streets, gutters, sewers, and then the street lights. And then you can sell that as a parcel that's been subdivided into little lots. So if it's residential, then a residential builder can just go plop townhomes or houses on it. Or if you've set it up to be, let's say, an apartment complex, the builder of the apartment complex can put a shovel in the ground and get started the day they buy that from you. Land tends to be a little more risky, a little more uncertain in how long it's going to take, but it tends to have higher returns to offset that sort of a risk. So we will occasionally invest in these sort of projects if it's something that we understand really well, but we don't like to have very much of the portfolio in it because it is higher risk and higher return. By higher risk, what I mean is that the returns we can usually calculate with a good degree of certainty in advance. So that's not usually the risk. The risk factor is like, how long will it take? They think it's going to take you 15 months to get through the entire process, and you're going to get a 30% annualized return. But it ends up taking 2 years to get it approved, and now you're going to be like at a 17% return. You can go from a 30 to a 17 return with the same amount of profit just by the fact that it took quite a lot longer to get it done. It tends to be the time uncertainty with land that bothers us a lot more than the amount of profit uncertainty. So it's good to have a little bit of this in your project, but not a whole lot. So self-storage is pretty self-evident. What that is, the reason why we like self-storage is that it tends to be counter-cyclical. So what's great about that is that if you go into a recession, some of the people on the lower end of the workforce will lose their jobs, get a new job where they're getting paid a little less. Now they can't afford the place that they're renting right now, and they may have to move in with a roommate or move in with their family. And that often requires less space being available to them than they had before the recession occurred. And now they've got all this stuff that they've got to store someplace. And self-storage is where that goes. So amazingly enough, we'll see usually a little more demand in the self-storage sector in a recession than we will during good times. It's nice to have a hedge like that during a recession. Recession shifts, I told the story a little bit about a sequence there, but when we see hospitality on the economy part of the continuum tends to be a little busier during a recession, and luxury tends to suffer. So that's what I mean by that. So let's take a look at what this looks like here. Here's an example of one of the new multifamily builds that we decided to invest in as a limited partner. This one is in Minneapolis. So these photos here are renderings of what we'll be building for this project. So we really liked working with these guys because it's relatively low risk. It's a very premium location within Minneapolis, which is a nice, growing, large city. They've got a good track record of rent growth, and closer into the city, there's demonstrated demand for more product. So as a result, this one's a little bit lower on our rate of return. It's 14%. Our target for our overall portfolio is 17 to 20% per year, but we'll put in one or two really safe bets, really low risk, which correspondingly lower return, just to blend out the overall risk of the portfolio. One nice thing about this is that we do expect about a 9% cash on cash return once it's been built and we've had the lease up. And that's sort of based on prior projects that these guys have done. So I'm going to talk about sponsor in a minute, but I'm going to give you a preview of it here. These guys have built over 13,000 units over their lifetime, $2.7 billion of new development. So can they handle a 150 unit project in their home market? I think they're going to do just fine at that. There's probably not very many problems that they haven't had before over the last 20 odd years that they haven't experienced. Another thing is that the 14% rate of return that we've sort of published to set expectations with our clients is it's really conservative. That's assuming that a lot of things don't go well. The historical rate of return for this sponsor is closer to 21% per year. And if we have a reasonably good set of economic outputs, this project is probably going to be closer to that sort of a range. So that's an example of one that we invested in recently and some of our thinking that we had when we decided to go into that. So let me just show you in Fund 1 how we decided to diversify out. We had 8 investments, so 4 in multifamily, self-storage, student housing, office, and hotel. More typically, what you'll see is two-thirds multifamily, and then the rest of it will be usually try to have industrial, which we didn't have in this one. Loved having hospitality, and then if we get student housing or self-storage, that's always really great. So this is why the investors like to leave the heavy lifting to us. As Tom explains in this testimonial, determining where to invest is incredibly challenging in this environment. So I've got an ability to understand and analyze the real estate deals and know where and when to direct the funds for maximum gain. And it's just a lot of time. There's the three of us on investment committee plus one analyst, so there's four of us full time. All we do all day long is think about what we should invest in, and we're constantly flying off to see projects and validate and then follow up and visit the sponsors after the fact. So the third pillar of investments is diversification as strategy, and this is one of the more important ones that's difficult for you to do just as an individual investor. So let's talk about that a bit. Investors need to diversify across strategy, and there's three broad themes you can select from when you're building your portfolio. So we've got buy and hold, which is just rental income, improvement or value add, and finally development or new build. So an important concept for you is to choose between them is what is your risk tolerance and what's your time horizon and what kind of demand for liquidity might you have. So risk tolerance in investing is your ability to handle fluctuations in the value of the investment. It's like the uncertainty that you might see with watching NASDAQ or the S&P 500 stock index go up and down and up and down. Some people never even look at this. It doesn't bother them at all. Some people look at it several times a day, and it really drives their blood pressure up and down. One of the nice things about real estate is that you don't have pricing posted on CNBC every 15 minutes to stress you out. So factors like your age, financial goals, personal feelings about risk all play, and your spouse's profile towards all that, all play a role in determining what your risk tolerance is. So we usually find that younger investors are a little more willing to take on risk in exchange for higher returns. Older investors usually are a little more conservative, and also they tend to be more income seeking versus the younger investors might be investing more for the long term and long term growth. So where you're at in the arc of your investing career, of course, will have a big influence on what makes the most sense for you. So for the first strategy is buy and hold. This is where we're going to buy a nice property in nice condition. It's being managed well and it's providing reliable cash flow. Usually newer properties, or they're older properties that maybe they just came off a really significant renovation and they're looking really, really sharp. You probably, if you're an active landlord, have a few like this of your own that you're running. So the advantage is that they generate predictable cash flow, and management-wise, they're a little bit less work. The downside, and there's less risk, less volatility of earnings. The downside is that the amount of return is the lowest with this sort of a choice. One other nice thing is that if this is appealing to you, you can invest in something called a REIT, Real Estate Investment Trust. And there's a great tax advantage in a REIT in that the income generated for most taxpayers is going to be treated in a more tax favorable way than income that comes from an investment property that you own directly. So you'll want to consult with your CPA for sure on this to find out how this impacts you. But if that's appealing, this is not something we do, but it's certainly a very viable option. There's lots of REITs out there. There's REITs that just do hospitality, some that just do industrial, some that just do multifamily. Whatever you could dream up, there's probably a REIT that does it. The downside of the REIT, in addition to the fact that there isn't any opportunity to earn high returns, is that there's also no opportunity to earn any depreciation, which is a tax write-off you can use to offset gains you might have somewhere else in your portfolio. So again, consult with your CPA. You may not have any need for depreciation, so this may not be a material factor for you. But for those of you who do need depreciation, REITs, this is a really large disadvantage of that particular strategy. The next strategy I want to talk about is buy and hold. Improvement rather. So this is value add. So these are properties that are not in great condition. They might have deferred maintenance, they might have style challenges, they might have terrible management, they may have a terrible online reputation and no social media marketing. And as a result, the rents that they can achieve are much below the market, and the vacancy rate might be a lot higher than typical, or both. And as a result, buyers are not excited about buying these sort of properties. A, because they don't want to do all the work. B, they may not have the extra cash to invest in the property to bring it up to snuff once they buy it. And third, lenders are not very excited about buying a damaged property and lending against that either. So you've got a lot of headwinds that reduces the buyer pool. So as a result, you can often buy these at a very, very good price. We like to do these projects because we can get depreciation, extra depreciation, usually, that we can pass on to our limited partners. So if you need to have extra tax write-offs, this is a way that we can generate those for you. So these projects are a lot more work, a lot more risk, require a lot more experience and expertise in exchange for getting much higher returns. Ideally, we'd like to have about half of our portfolio be in this sort of investment. And the way we offset the headache risk is we only like to partner with sponsors that have a really deep track record of doing these sorts of projects. So development is the third big strategic class of real estate. So here we're going to build something from scratch. So we can either do it where we're starting with raw land, and we do the value add to the land like we talked about a little while ago. And when we're ready, we put the shovel in the ground and actually build it. The other way to do development is you have a developer just on the land side, which is often called horizontal development. They do the land entitlements, get the zoning set, help get the plans in place, and they sell it to us and our sponsor at the moment at which you're ready to break ground on a piece of land that's been approved by the government and you've already got the permits in hand. What's nice about the second approach is that it reduces the time variability quite a lot. You know that you're going to break ground as soon as you close on it because you've already got the permits and the plans all set to go. This tends to be the strategy that we like with new developments. It drains some of the risk from it. So continually amazed how many people have an interest in becoming a real estate developer. It sounds sexy to a lot of people for some reason, but it really is a lot of work. I've been a developer for 20 years, and there's joys and headaches. But I do have to agree, there's a lot of satisfaction at the end of the project when you see a finished product. And it's just beautiful, and you've improved a neighborhood and you've made a community better for the residents than it was before. It feels like you've really made a difference. So that's really, really exciting. So higher return, higher efforts, and a little more volatility. This is usually about half of what we do. So let me just show you an example here. This is in Fund 8, and here's some before and after shots of a class kind of C plus building from the 1960s that hadn't ever had an update, and you can see what a difference it made before and after, and no particular surprise, it was a really large increase in the rents during our after situation on that. And if you want, you can go through the slides later. Here's a little bit more detail on that particular project. It's about an 18% annualized return. Historically, that sponsor's done quite a lot better than that. And here's a couple pictures of some new development. This is workforce housing. We love doing those types of projects as well. Okay, so the Fund 8, we wound up with new development being about 6 of our projects and repositioning being about 2. I'd like to have that be a little more balanced. Right now, it's difficult to find repositioning products that really make a lot of sense, and there's a decent number of development available. So we will have to bend and flex our desired portfolio allocation based on what we see in the market and which projects match up to the strategy that we want to try to implement. So there'll be a little bit of variation from one fund to the next just based on the timing of what we can find out there. So this is from one of our investors, Jay. Really enjoys how I've had fewer headaches. I've invested less time as I've gone from being an active investor to a passive investor. And I also appear to be on track to actually beat the returns I was generating when I was doing it all myself. So we've really, I think, been able to improve Jay's quality of life quite a bit. So the fourth pillar is on the sponsor. So an often overlooked fact as an active investor is that you are the sponsor. And if you make a mistake on one of your properties, it might be the kind of oversight that leads you to make the same mistake on multiple properties across your entire portfolio. Every sponsor has strengths and weaknesses, and everyone's going to have a blind spot. So if you have all of your investments with just one or two sponsors, you're going to be concentrating that sort of a risk. If you have multiple sponsors, you're going to be able to diversify part of that risk away. So that's one thing that we really like to do. During the due diligence process, we're very interested in taking a look at operational, financial, as well as third-party due diligence. And I talked about that a little bit earlier, how we like to fly to every site, see the site, see the sold comps, visit the rent comps that we used, interview the sponsor, ideally see prior projects that they did, ask them, what problems did you have on this project? How did you solve them? What were the pros and cons? If you had that problem again with this project that we're about to embark on with you, what approach would you take? And we just want to make sure that we've got good contingency plans in place for the problems that realistically are most likely to happen. And this is where having a couple of decades of experience with all of us on the investment committee really comes into play, because we've been through a couple market cycles, and we've all been in situations where we've been ambushed in a project in the past by a problem, and we've had a footnote in our mind ever since that if I'm ever going to buy a project like that ever again in the future, I'm going to make sure that I look into this, ask about that, check on this other thing, so that I don't get ambushed again. We covered all those ideas. So let's just take a look at Fund 1. So diversification, we've got geographic diversification, strategy, asset class, and then also the sponsors. So a lot of different ways we can bring diversification to the portfolio to manage our risk a lot. Net for Fund 8, for example, will be in 56 different commercial properties in 10 or 11 different states. So this gives me peace of mind when I see that the next hurricane is going to be landing in South Carolina, and I know that we've got a couple of projects there. I think it's highly unlikely that any one of my projects is going to get hit. And if it does, like at worst, I'm going to have one project that gets flooded and it sets my timeline back by a couple months. I've got insurance. I'm not worried about that. It's more the timeline that I'm worried about. If I only have a small number of investments, a big disaster like a hurricane can have a really, really big impact on the overall portfolio, and I don't want to have that kind of exposure if I don't need to have it. So Fund 8 came together really well. We're expecting a 21% annualized return. That's a little bit higher than we normally get. We just had a couple of hotshot investments in that one. The timing on the investment. So all of the money went in 2024. We anticipate most of the money will come back in 26 and 27. Most of the profits will be delivered in 28 and 29, and that's pretty typical for most of the investment funds that we run. So taking a look at some of our prior projects, you can see that our target returns have been generally in the 14 to 20% range for our growth funds, and that's generally speaking where we've been at. We've got one that's going to be a little bit more than that, but not many below, not many above, just sort of like right down the middle is where we want to be at. For the income funds, we've always come in on track in the 8% range for the short-term fund and the 12% range for the medium-term fund. So Jesse has been working with us for years, and he really likes the unique methodology that we've got for selecting investments, and he likes that we do all the heavy lifting, and he likes our reliance on historical analysis and proven modeling techniques. For Jared, he's an active landlord that's transitioning to passive. His last 4 tenants really ran him really badly, and he sold them off, and I think he's just really happy to have more time with his family and a lot less stress and not spending all of his time on weekends dealing with his rental properties and getting to spend more time with his kids. Justin is an entrepreneur that used to be an active investor, and he's also been transitioning to passive. He's been able to build a portfolio with us that generates, similar or better returns than he had before, and he doesn't have to worry about things nearly as much. So I think he's just a lot happier than he was before. So picture this. You finally have got your time back, time to relax and enjoy quality time with the people who matter while your portfolio continues to grow in the background. I want this for you. So let me ask you, did we provide some value to you today? Did you get some insight into what you might have been missing when you thought passive investing was out of your reach? Would you like to get more? Every investor is not the same. So we've got 4 different products that we can provide to you and customize it to your unique requirements. We've got the National Diversified Fund. It's a 5 or 6 year time frame. Average return is 17 to 20% per year. but there's no liquidity to it. So if you're investing for the long haul and you don't need to have access to the funds, this is going to be a great match for you. If you've got some funds that need to be liquid, you need to be able to have access to them on short notice. So, like if you've got, say, $100,000 in a capital account fund, and you need to be able to access that immediately in case you have like a problem replacing a boiler at one of your buildings, for example. The short-term fund is a great match. So it pays about 8%, and it's got a tax-preferred treatment as a REIT. So check with your CPA, but for many of you, that'll reduce your tax liability with the dividends from this fund. If you don't need immediate liquidity, the medium-term fund might be a good match for you. So it pays between 11 and 13%, depending on how much you've invested with us. It comes in quarterly dividends, just like our short-term fund. This one does not have any liquidity for the first year, but after that, you've got liquidity on a one-quarter basis. Another nice thing about this is that it's not invested in real estate, it's invested in medical receivables. So it is not related to the returns of the stock market, the real estate industry, interest rates, wars in Ukraine, or anything else, because people have medical issues regardless of what the rest of the economy is doing. So if all of your investments are concentrated in the stock and bond market and real estate, and you want to diversify a little further, this is a great way to be able to do that. Finally, we've got a fourth class called single asset funds. Occasionally, we'll have a special real estate project that is interesting, and we'll offer an investment just in that one project. Those pop up from time to time, just as we find things that are sort of interesting. So joining Ironton is going to enable you to get rapid results because we do all of the finding, touring, due diligence, and analysis for you. And since you're going to have more time to do what you want, when you want, with the people that matter the most, you're going to have greater diversification across geography, asset class, and strategy. And this investment is going to be entirely and truly passive. We do all the heavy lifting, provide quarterly updates, and you deposit the gains. Does that make sense? Are you getting all of it? If I did a good job, would it be okay for me to share with you how you can go deeper with us if this works for you? First, who is this not for? So it's not going to be for people who want to do it the long, hard way, not for people who want to jump in with their eyes closed. I want you to know exactly what's included, and you want to check with your financial advisors to make sure that we're a good fit for your overall portfolio. Who is it for? It is for accredited investors who are done dealing with landlords, done having the exposure to changing laws governing how the industry works, or the endless deals they've got to sift through, and they just want to leave all the heavy lifting to the experts and get on with their life. So, an accredited investor. So, if you're single with a household income over 200 grand, or if you're a dual income household with income over 300,000, or if your investable assets are over $1 million, you are accredited and we are allowed to work with you. So keep in mind, there's a lot of different ways that you could fund these investments. A lot of our investors use cash. They will use a self-directed IRA, either a Roth or a traditional. They'll get a line of credit to take out cash, either from their primary residence or a vacation home. Or if you have a rental property with a lot of equity, I've got some bankers I can introduce you to who might be able to put a line of credit on that property so you can tap that debt equity and put it to use. So I'm very happy to make those introductions for you. So giving back, I am on the board of directors at the Denver Zoo and the Ronald McDonald House and Boys and Girls Club. I've given over $250,000 to these charities over the last couple of years, and I'm going to be giving some of the profits of our fund to those charities. So I'm excited to be able to give back to our community here. So because investing is individual to each person, I want to set aside some time for you and would love to hop on a call with you and answer all of your detailed questions. So you can use this detailed link, irontoncapital.com/review, to set up a call with somebody on our investor relations team, and you can share your goals. And we'll try to find out if we're a fit for you and which funds might be the best match for you. We're here to make this an easy process, but our time is limited, so go ahead and book now, and we'll talk soon.